Hello again, this is Harjinder, and we are looking at the additional practice questions for topic 3, the passive investments topic. Practice question number 3 covers 4 investments. The basic requirement here is to determine the amounts that will be reported by Alpha on its 2001 Statement of Comprehensive Income and the Statement of Financial Position. The income tax rate is given to be 25% in case that comes into play. So there's 2 bond investments and 2 shares investments. First one, Beta Limited bonds. If we skim read it, the bonds are being accounted for as amortized cost, and then Theta Limited bonds are accounted for as fair value profit or loss. For the shares, we've got Sigma Corp shares accounted for as FVOCI, and Super Corp under fair value profit and loss. So we're going to make a partial statement of comprehensive income and a partial statement of financial position. To get started here, in the name of Alpha Inc. and statement of comprehensive income. Partial statement, of course, and so the year ended December 31st, 2001. 201. Okay, so here we have to do a little bit of thinking. For the bonds, we will have interest income, right? So there will be a line for interest income. For the Sigma Corp shares, we will have a line for dividend income. The Super Corp does not report dividend income separately, so we'll have a line for investment income from FEPL. So under other revenues and expenses, we will set things up. We will have a line from interest income. We will have a line for dividend income, and then investment income from FVPL. Those would be the very minimum that you need to report. And then it's quite likely that we will have some other comprehensive income to report for Sigma Corp common shares. So we will set aside some space for that other comprehensive income. We just don't know which way it goes, so we will leave the space for now. On the balance sheet, statement of financial position, partial, and it's at December 31st. So the FEPL investments are reported as current assets. We're going to have the Theta Limited bonds as an FEPL investment, and we have Sigma Corp common shares. That's the Super Corp common shares. That's an FEPL investment as well. These are reported as current assets. Under current assets, we will have fair value profit or loss investments. And under long-term investments, we are going to report our investment in Beta Limited bonds. That's the amortized cost. Under amortized cost. And we will report our investment in Sigma Corp common shares. That's FVOCI. And since there is Sigma Corp shares are reported under FVOCI, also remember that we will have accumulated OCI in play. So shareholders equity, under shareholders equity, will report accumulated other comprehensive income, investment in Sigma Corp FVOCI. So we've just laid out our answer, our landscape for the answer. Now we have to do the calculations of the amounts. So here we go for calculations. First is our investment in beta. Investment in beta, we on Jan 1st year 0, so that was the previous year. We're making partial financial statement for the year 20x1. 20x0. So the previous year on Jan 1st, Alpha had bought $500,000 face value, 10% bonds of beta. Bonds pay interest every December 31st, maturing on December 31st, 20x6. The bonds were acquired to yield 9%. So the bond coupon rate is 10%. They were required to yield 9%. Thirdly, Alpha must not have paid $500,000. Since the bond coupon rate is more than the yield rate, the bonds must have been purchased at a premium. The market yield for similar bonds was 10% on December 31st, 20x0 and 9.5% December 31st, 2001. We don't really care about the market yield here because Alpha manages the investment as amortized cost. It's reported under amortized cost. We don't care for the market yields because we are not going to make any fair value adjustments. But we do need to calculate the cost of the investment and then make an amortization schedule, certainly until the end of 2001. So beta bonds, amortized cost. So on Jan 1st, year 0, face value 500,000, coupon payment. The bonds have a 10% coupon. The number of years to maturity, the bonds mature on December 31st, 20x6. So if you start from 20x0, probably easiest if you just replace the x with an actual number. So say you bought the bonds 2020, Jan 1st, 2020, and the bonds mature December 31st, 2026. You want to include 2020 and 2021, 2, 3, 4, 5, and 6. That's a total of 7 years. Okay, 7 years. If unsure, count the number of years on your fingers. So 7 years, calculate PV. So present value, the rate. Oops, I needed the rate. Forgot about it completely. So if I want to compute the PV, I need the market interest rate. At the time the bonds were acquired, the market interest rate was 9%. So calculate PV, the rate was 9%, number of years 7, the coupon payment 50,000, and then the bonds have a face value of 500,000. All said, the fair value of the bonds at the time they were acquired was 525, 164, and 76 cents. I just like to round all the numbers to the nearest dollar. We don't worry about the minutiae. 525, 165. That's what we must have paid to the nearest dollar for the bonds. And the amortization schedule for the bonds, we only need the amortization schedule up to December 31st, year 1. But since it doesn't really take a lot of time. We can prepare the entire one just to check whether everything works out. So date, cash, interest, amortization, and balance. So Jan 1st, 20x0. We purchased the bonds for 525, 165. Every December 31st after that date, up to December 31st, year 6, the company Alpha will be receiving $50,000 in cash. Which will include interest at 9%. Okay, made a little blooper there, forgot to include the first date here. So interest will begin here at 9% of 525, 165 for the first year. Just rounding it to the nearest dollar there. And we want to make sure our interest rate is fixed at 9%. So for the first $50,000, the $50,000 will include interest at 9% on the 525, 165, which is 47,265. The difference, 2,735, reduces the investment balance. And we expect this to happen, continue, because at the end of year 6, we expect to see 500,000. So notice here we are out by $1, and that's due to a rounding error. So the easiest thing to do is just fix this last piece at 500,000 and then cheat a little bit on the amortization and the interest. So the interest basically will be whatever it takes to make the final balance equal to the face value of the bonds. A $1 or $2 rounding error, just round it to the interest number. Anyways, we are interested in just the numbers for year 2001. So interest income will be reported at 47,019, and the investment will be reported at 519,449. So on the statement of comprehensive income, interest income will be reported at 47,019, and on the balance sheet, investment in beta will be reported at 519,449. The next investment is investment in Theta. So for investment in Theta on Jan 1st, 2001, the current year, Alpha purchased $300,000, 8% bonds of Theta Limited for 280,981. The bonds pay interest annually every December 31st, will mature on December 31st, 2004. The market yield for similar bonds on December 31st, year 1 was 9%. And we are using the fair value profit loss model. So when using fair value profit or loss model, it does make sense to make an amortization schedule, because the very nature of a fair value profit loss investment is that the company is not averse to the possibility of selling the investment at any time. So there's no point in preparing an amortization schedule there. So they purchased on Jan 1st, year 1, the company purchased the bonds for the amount provided is 280,981. Now we can, if you like, we can calculate what the effective interest rate must have been. If you are interested, we can do that while we are here. So 300,000 face value 8% coupon rate. The time to maturity was 4 years at that time. We can use this information to calculate the rate. We just don't need it at this point because we're not making an amortization schedule. So number of periods was 4 years. The periodic payment is 24,000. The company paid 280 and change and will receive $300,000. So the market interest rate at that time was 10%. Good to know, but we didn't really need that. What we do need, though, is to calculate the fair value of the bonds, which is essentially for bonds, fair value is nothing but the present value of future cash flows. So at the end of year one, the number of years remaining drops from 4 to 3, and the market interest rate at that time dropped to 9%. So 9% instead of 10%, market interest rate is 9%. So using 9%, we calculate PV, right? We calculate present value, PV, putting 9% as the interest rate, 3 years to go, annual coupon of 24,000, and then face value of 300,000 gives us present value 292,406 and change. We'll just round it to the nearest dollar. So the way we work with FVPL bond investments is that we will use the coupon payment of $24,000 in this case as interest. So we're going to report interest income at $24,000. So $47,019 from the beta bonds and $24,000 from Theta is reported as interest. And we're going to have an additional line for unrealized, basically an unrealized gain will occur here because the fair value of the bond at the end of year one, 292,406, is more than what it was at the beginning of the year. The change is 11,425. So that basically gives us our gain or loss here. It's a gain of 11,425. So the investment itself is reported at 292,406. And then we have this gain, which gets reported on the income statement portion, 11,425. So unrealized gain on FVPL, 11,420. And the investment itself goes to the balance sheet at 292,406. Right, 292,406. So that takes care of our Theta bond investment. Next, we've got the Sigma Corp common shares. So on Feb 1st, 2001, Alpha acquired 40,000 shares, representing 10% of the outstanding shares of Sigma at a price of $14 a share, plus brokerage commission of $12,000. On August 1st, 2001, Sigma declared and paid a dividend of $1 a share. On December 31st, the shares of Sigma were trading on the stock exchange at $14 per share. Alpha accounts for this investment under FVOCI. There was no sale of the shares at all during the year, so that's good. 40,000 shares in total. Market price at the end of the year, $15 a share. So Sigma shares, FVOCI. Fair value at year end, 40,000 shares times $15. That works out to $600,000. The cost of the investment was 40,000 shares at $14 a share, plus there was brokerage fees of 12,000. So 40,000 shares times 14 plus 12,000, that's 572,000. The difference, $28,000 is an unrealized gain here, which will go through OCI though in this case because the investment is fair value OCI. The dividend on 40,000 shares, company paid a dividend of, well, $1. So that was pretty easy, $40,000. So the dividend on the FVOCI shares will be reported here on the income statement portion, fair value OCI dividend, $40,000. And then under other comprehensive income, we will have unrealized gain on Sigma, investment in Sigma, and that is $28,000. The investment itself is reported at 600,000. So these are the numbers in place. 600,000 is reported on the balance sheet. 28,000 goes to OCI. 40,000 is reported in the income statement portion. And so we have to remember the 28,000 OCI will also be reported on the balance sheet in accumulated other comprehensive. Now, again, this should be net of deferred taxes. We're ignoring the deferred tax portion. All right, last little bit then is for SuperCorp common shares. So SuperCorp Alpha on Feb 1st acquired 18,000 shares of SuperCorp at a price of $50 plus brokerage commission $1,500. On August 15th, SuperCorp declared and paid a dividend of 60 cents a share. November 15th, Alpha sold 4,000 shares of Super at $46, less brokerage commission of $600. And on December 31st, year one, the shares of Super were trading on the stock exchange at $48 per share. We use the FEPL model, and we choose not to report dividend income separately. Hence, we'll just collapse it all into one line, investment income. So with regards to Super then, we began with 18,000 shares, sold 4,000 shares, so must have 18 minus 4, 14,000 shares remaining at the end of the year. The market price was $48. So 14,000 shares times $48. So fair value at year end, 14,000 shares at $48 each. That's 672,000. The cost was we had purchased these shares originally at $50 each, right? $50. Remember, brokerage fees are expensed under fair value profit or loss. So in a bit of a roundabout way, we can calculate $28,000 is the loss on sale. We sold, sorry, not, this would be the unrealized loss. Amount was different, unrealized loss, 28,000. Likewise, on the shares that we sold, 4,000 shares sold, the sale proceeds on shares sold was, well, we sold 4,000 shares at $46 each. Again, the brokerage fees are expense, so let's keep them out of the picture. The cost had been $50 each. So we're looking at a loss on sale, $4 a pop times 4,000 shares sold. That's $16,000. The dividend. Now, the dividend was declared by Super on August 15th. Alpha sold its shares on November 15th. So the dividend was declared before Alpha had sold its 4,000 shares. So the dividend declared on August 15th was received on all 18,000 shares. And the dividend per share was 60 cents a share. So total dividend then must have been 18,000 shares at 60 cents per share. That's $10,800. Lastly, the transaction costs, the brokerage fees, etc. Remember, they are expensed. The first time when the shares were bought, paid a brokerage commission of $1,500. And when the shares were sold, brokerage commission of $600. So 1,500 plus 600, we're talking about $2,100 as being the expense. Yeah. So these four items here added together will be reported as a single line on the income statement portion. And the balance sheet amount is the fair value, which is 672,000. So here goes. Remember, we have this other FVPL investment, the Theta bonds. So that's already there, 292,406. We will add to that this guy here, 672,000. Total 964,406. Investment income will be the sum of 28,000 negative plus the 16,000 negative plus the 10,800 plus the 2,100 negative. So that gives us a loss basically of 35,300. So I can just change that. Investment loss. Investment loss from and yeah, that's all we have. So I didn't really use the income tax rate of 25% in this solution. If at all it were in play, we would have reported this number as net of deferred tax. But I would say, don't worry about it. Just leave it for now and then focus on the bigger picture. Do you know where the numbers come from and where they go? So that, my friends, was practice problem number 3 from topic 3.